Welcome, everyone, to our United Church Funds Town Hall. I'm Charles Bach, President and CEO of United Church Funds, and we're all delighted that you're here with us today. On screen, you're going to be seeing First Congregational Church in Bellevue, Washington. That's in the Pacific Northwest Conference. We are honored that they, like all of you, have entrusted us with the stewardship of their assets. We like to showcase our clients' churches in our presentation materials and in our communications. So if you've got a nice photo to share of your church, I encourage you to send it in. And who knows, you might see it in one of these town halls or perhaps our next annual report. Can we go to the next slide? Here are some reminders of who we are, what we do at UCF. And while you're looking at this, I want to inform you that while our goal is always to be as informative as possible in these town halls, everything that we cover here is for general knowledge only, and nothing said here should be construed as giving any kind of legal, tax, investment, or financial advice. For any of these, you should, of course, seek a qualified professional. Also, if you have questions at any time during this town hall, I want to encourage you to drop them in the Q&A box and we will answer them at the end, as many as we can. And if we could go to the next slide. Well, we're excited to be with you because we've got a lot of updates to share with you. But ahead of that, I want to mention something that you may have heard about. Earlier this week, UCF co-filed a lawsuit in Texas against a state law there that targets proxy advisors. A proxy advisor assists investors like UCF with the thousands of shareholder proxies that we vote every year at corporate annual general meetings. The reason that UCF is bringing this lawsuit, along with our co-plaintiffs, the Interfaith Center on Corporate Responsibility and Series, the reason that we're bringing this lawsuit is that the law is so broad and so vague that it could be enforced against even UCF. For example, simply letting you know how we voted and why we voted on a proxy could trigger certain requirements and sanctions on UCF. So this action is one of several ways that we have been working to uphold and protect the rights of shareholders and investors. Shareholders are the owners of public companies. And recent attempts to dilute and erode the rights of shareholders by states like Texas, as well as by the US Congress, the SEC, and large companies too, these are especially troublesome because, among other things, they upend basic democratic principles upon which our country is founded. You can read more in the press release that we've posted on our website. And if you have any specific questions or want to learn more, just generally about what we do and our strategies here at UCF, I invite you to send an email to me or to our General Counsel, Noah Tabor. So before we turn to our agenda, I want to highlight our marketing and communications team of Debbie Wibowo and Adam Sank. I consider them sort of like the Wizard of Oz working behind the curtains. They make these town halls happen. So a big thanks to you, Debbie and Adam. And finally, my thanks to all of you who are joining here today for entrusting UCF to be partners with you in the stewardship of your assets, all for the sake of God's mission and for a just world. So I'm pleased now to introduce Kelsey Rose of our Institutional Relationships team to bring you organizational updates.
Thank you, Charles, and thank you for sharing that important news item with all who are here and all who are watching. And yes, we do have a few more reminders and organizational updates to share today. First, we've made a few changes to our client account forms, which are the forms you would use for deposit or withdrawal request, creating a new account, any of those types of requests. We've updated those forms based largely on client feedback, and they are designed to make all of these requests a smoother experience for you and your organization. You can find the newest versions of these forms on the UCF website, and they are linked here in the webinar chat. And we wanted to share about the changes to these forms with you here at the town hall because we wanted to let you know that we are listening to your feedback And also, we know many clients like to save and use older versions of these forms on their computer when they're creating new requests. And we will still accept those older versions of the forms, but we do highly encourage you to visit our website and download the newest versions for all of your account and transaction needs. And we're also pleased to share that we have kicked off season 2 of the Just Investing podcast. The Just Investing podcast audience and network of special guests continue to grow, and every episode is an excellent resource to explore current issues and conversations concerning the world of responsible investing. So we welcome you to take a listen to episodes from season 1 and season 2, and we hope you will share with others who you may know and may find the Just Investing podcast helpful. And then, because we are nearing the end of the year already, we also want to remind you that yes, UCF can process stock donations from members or donors who wish to support your mission through gifts of appreciated stock. And no, there's no charge for UCF clients when we process these donations for you. But that said, it's very important to submit the stock donation form, which can be found on our website and linked in this webinar chat, because this form helps us tremendously in both identifying incoming donated stock and the client who is receiving the gift. But also please keep in mind for 2025, the deadline at UCF for these stock donations in order to ensure processing for this year is December 10th. And last but not least, we are thrilled to share that Matthew Illian, our Director of Responsible Investing, will be honored with the Bridge Connector Award at the Investor Advocates for Social Justice, or IASJ's 50th Anniversary Gala this December. This award celebrates an individual who has built meaningful relationships across sectors, perspectives, and experiences, which is an accurate reflection of Matthew's character and his commitment to connecting people and communities in valuable ways. So we too are celebrating this well-deserved recognition. Congratulations, Matthew. And more information on the IASJ Gala and this award can be found in the link provided here. And speaking of Matthew Illian, it is quite fitting that I now turn the floor over to him. As UCF's Director of Responsible Investing, Matthew is here with us to keep all of you informed on the responsible investing work at UCF. So welcome, Matthew.
Thank you, Kelsey. I appreciate that warm welcome. And Charles at the top mentioned the lawsuit that we filed in Texas related to proxy voting. So I actually wanted to start this part of my presentation talking about how we use proxy voting. So for a quick primer, proxy voting is the power that investors have to vote on critical issues at shareholder meetings that happen once a year. So we are voting on, for example, the executive pay packages. We are voting on who gets elected to the board of directors. We get to vote on mergers and acquisitions, and also on auditors and on shareholder resolutions, many of which we file. So the votes are tallied at the shareholder meeting, and then the preliminary results are announced. And it's called proxy voting because most people can't show up to those meetings in person, and so usually a proxy is designated. So that's why they're called proxy votes. These votes are mostly advisory in nature. And I found out legally, I mean, that's called precatory, advisory in nature, and precatory or precari in the Latin is to pray. So we pray. Sometimes the management will listen to us. They don't always. But in fact, we do find that particularly when there are significant votes, either for or against certain issues, then we do see that management does pay attention. And we believe this is an important part of our fiduciary duty to vote in alignment with our values. So Adam, if you go to the next slide, I want to talk about specifically at UCF. In addition to that lawsuit, we also were asked to send in comments to Congress, in particular to the U.S. House Committee on Financial Services. They were having a hearing on proxy power, and they wanted to hear how UCF uses our proxy voting, both powers, and how we rely on consultants to help us advise us in those votes. We vote on over 1,000 different shareholder meetings or companies every year. And so, as you can imagine, um, we're not able to do all of that research ourselves. And that's why we do rely on these third parties to help provide us with their research so that we can make informed decisions. And in fact, this past year on executive compensation, you can see we voted against executive pay packages or compensation packages 35% of the time. And that, the reasons for that are varied. Sometimes, it was deemed excessive because of stock options, or in some cases, the company just performed poorly, and so there wasn't a reason to reward those executives. But we think, these votes take a lot of research. They take a critical eye to kind of understand, discern whether this is fitting or beyond reason. And then we also voted or withheld support against 14% of director nominations. And in some cases, it was because they lacked critical skills, for that were needed on the board. Sometimes those board members lacked independence, meaning they were too tied to the CEO, or maybe the chairman and the CEO were one and the same person, and we felt like that for that particular company, that was a big issue. Sometimes they lack diversity on the board, and that's a reason that we will sometimes vote against directors. So wide variety of reasons that we will vote against directors, but most of the time we vote for directors. So you can see 86% of the time we support the nominations from the board for director. If you go to the next slide, while we're talking about excessive pay, we can't talk about this and not talk about Tesla. Just a few days ago, last week, Elon Musk pay package was up for a vote. It was summed up as a $1 trillion package. And in fact, 75% of shareholders voted in favor of that. UCF was not part of that group. Elon Musk accounted for about a third of, or 30% of those votes. So he got to vote on his own pay package. And of course, he supported it. But I think this was a real important moment to kind of understand how high these pay packages have become. And you can see the CEO to worker or median worker pay last year is now at 283 to 1. And if you go back to the 1950s, early 1960s, that average was around 50 to 1. So that inequality has grown significantly. And it's something that we're watching closely because that's also driving inequality across the economy. We have partnered with some other members through our Interfaith Center on Corporate Responsibility, or ICCR, to start an excessive executive compensation working group and campaign. So I expect, or you should expect, to hear more on our efforts to really highlight this issue and really to focus on the fact that investors have been supporting these pay packages, large majority of the time. And often these pay packages get well over 90% support. And so this is an issue that we're going to be paying close attention to and really focusing on in the next few years. And in fact, our last Just Investing podcast, we had Tejal Patel came on as our special guest. She represents pension plans across the U.S. So union pension plans, union workers, and they've done a lot of work researching Tesla's pay package and found that several parts of it were in fact very easy to hit. There are 12 targets, some of which are moonshots, but there were several $billion on the table that were not even that big of a stretch. So listen to that podcast if you want to hear more on Tesla's pay package and why groups like United Church Funds and others voted against it. If we turn to the next slide, the last kind of topic I wanted to cover is our engagements, and this one in particular on Dollar General. And the reason we have this timeline here is to show you that our relationships with these companies often last many years. And in fact, we started engaging with Dollar General back in 2022 when we got updates and we started hearing from workers that their working conditions were horrible. And this was during the pandemic, and they were essential workers being asked to do Herculean tasks by sorting, by keeping our economy going, and they were being paid minimum wages in many cases. And so we partnered with some of those worker organizations to allow them their voice to be elevated and show up at the shareholder meetings. We helped file a shareholder resolution on worker health and safety that got a majority vote and led to some important critical changes at Dollar General. But we continued to believe that they had work to do on ensuring that all of their workers' rights were being honored. We filed another shareholder resolution last year on asking them to create a human rights policy that covered all of their workers, which they didn't have. And we have recently been engaging them on what we've seen as a rollback of their diversity and inclusion efforts. They've taken everything down from their website, from their corporate filings, and in fact, they've been targeted by Reverend Dr. Jamal Bryant, who's a pastor of a church outside of Atlanta. He's called on the Black community in particular to stage an electronic boycott of Dollar General. And this follows a very successful boycott that they led at Target on similar issues. And so we have asked Dollar General to report back to us on how they're responding to this particular consumer boycott and how they're viewing this as a risk to their long-term sustainability, sales, and reputation in the community. So we will continue to engage with Dollar General, but we wanted you to see through this timeline how long these engagements last and how they evolve over time. With that, I'm going to transition to a poll question and also welcome my colleague, Matt Wagner, who's the Vice President of Institutional Relationships, to lead us through these two poll questions.
Thanks, Matthew. Good to see everyone on the call tonight. You have the poll questions in front of you. There are two of them, and you may have to scroll down a little bit to see all of the options on question number two. Both of these questions, you can select all that apply. So the first question is, which is kind of a backward-looking question. Which factors had the most significant impact on your organization's investment decisions in 2025? You have options of market volatility and inflation, responsible investing and environmental, social, and governance development, shifts in interest rates, organizational priorities and budget shortfalls, global or geopolitical events, or other, which you can type in the chat. And number two, and again, you can select any of those that apply. And number two, the same way, looking ahead to 2026, what will be your church or organization's top investment priorities moving forward? Again, growing long-term returns, preserving capital in uncertain markets, enhancing portfolio diversification or asset allocation, aligning and utilizing our investment goals to advance our mission, and expanding education or engagement around responsible investing. Or again, if there's another one that you'd like to leave us with, you can put that into the chat. And while we're aggregating all of those answers, Matthew, I just want to go back and congratulate you on the Bridge Connector Award from IASJ. The work that we do on the institutional relationships team, part of that is being able to carry the message forward. But you are a true bridge between our clients and this very important work. I want to congratulate you on the award, but more importantly, I want to thank you for everything that you do on behalf of our 1,200 investors to allow them to be able to fully invest based upon their values. So thank you for that.
Thanks, Matt. It's an honor to do this work with this team and on behalf of all the faith-based investors we have.
Excellent. Well, let's take a look at the answers to those poll questions. So let's start with number one. It looks like about half or so of the respondents for which factors, when we talk about 2025, kind of which factors had the most significant impact on your investment decisions throughout this year. About half or more, a little more said organizational priorities and budget shortfalls. We talk a lot about that with our clients and portfolio reviews, as you might imagine, as we go around the country. But the number one answer with 58% was responsible investing in environmental, social, and governance development. So we're grateful that you see as a mission priority for this past year the values aligned investing that we in the mandate to do so that we share at United Church Funds. Also getting about half of the response was market volatility and inflation. And we're certainly going to talk a little bit about that in the coming slides. And then we also had some answers there around the 20% mark with shifts in interest rates and global or geopolitical events. As we shift down to the responses for question number 2, looks like by far the biggest, the largest percentage of you selected as we look forward into 2026, that preserving capital in uncertain markets, with a 75% of you selected that option, is going to be a priority for you. And again, certainly we're going to be talking about some uncertainty in markets and maybe some changing landscape as we move forward into the next year. About half of the respondents selected growing long-term returns. Of course, that is a commitment of ours at UCF as well, to be able to responsibly grow portfolios for the long term to fund and support your missions and ministries. Next looks like aligning and utilizing our investment goals to advance our mission, enhancing portfolio diversification or asset allocation, and expanding education or engagement around responsible investing. So I want to thank you all for those responses to those questions. We do look at those. We're not just sort of asking to kill some time in these webinars. We look at those responses and bring you information in the portfolio reviews that we do that hopefully make our time together as useful and efficient as possible, so that we can help you achieve your goals in responsible investing and supporting your mission and ministry. Well, let's go ahead, Adam, and move forward on the slide deck and go into some investment performance and how we have worked to position portfolios. Let's first take a look at some market themes as we close out Q3 2025 and have gone into Q4 2025. Some takeaways that we can look at over the first 9 months of the year that are kind of continuing into this last quarter. Equity markets continue to rally. October was another positive month for U.S. markets as well as international markets. And your portfolios, those that are in the balanced funds, like the UCF Balanced Fund, the Beyond Fossil Fuels Balanced Fund, those very popular funds that we offer, certainly have benefited from the rise in U.S. equities, and maybe a bit surprising, the significant move that we've seen upward in international equities year to date 2025. Of course, we're going to talk tonight a little bit about the U.S. economy, and it has been resilient, but we're going to talk a little bit about some labor statistics that have come out more recently, and we're also going to talk a little bit perhaps about the impacts as we start to see the tariffs be implemented across the globe, and how those might impact imports, exports, and consumer prices here in the U.S. The Federal Reserve has cut interest rates first in September and then again in October. The next Fed meeting is on December the 9th, and we expect investors are pricing in another one additional cut. We're going to talk a little bit about that as we move forward. Of course, one of the larger themes that we've talked about for the last couple of years has been this concentration in the S&P 500 of these AI hyperscaler companies, these large growth tech companies, often termed the Magnificent Seven. We've seen we saw a little bit of a broadening of market returns in early 2025 to other industries, however, we've seen a little bit of a return to that concentration. And then lastly, as we always note to you, our diversified strategy at UCF is to ensure that we can provide to the best of our ability and to the best of the ability of markets to provide long-term consistent returns to our portfolios, because we know that our clients, those organizations and churches that invest with us, are relying on those assets to fund their long-term mission and ministry. As we go to the next slide, I want to remind everyone that if you have questions, please use the Q&A box. I see a couple of questions coming in the chat, a couple in that Q&A box. We encourage you to put them in the Q&A box so that we can take a look at those and spend time at the end of this call to make sure that we answer those questions as deeply as we can, given the time allotted. On this slide, we see some index returns through 3 quarters in 2025. For those of you that are familiar with these webinars, we show this slide almost every time. Just kind of gives you a rundown of where markets and where these indexes have been over the quarter, year to date, and then 3, 5, and 10-year timeframes on an annualized basis. So if we focus on that year to date column, second from the left on the chart on the left, you can see that the S&P 500 through 3 quarters was up about 20%. Developed markets overseas, so that's Europe and the Far East, that is the MSCI EFA or EAFE index, up about 17%. And again, a little surprisingly, the MSCI Emerging Market Equity Index up about 24%. And then small cap stocks here in the US, represented by the Russell 2000, up about 22% for the year. So broad positive returns across the markets, across the globe, have benefited portfolios of our clients and of investors. If you look down towards the middle of that chart, you can see the Barclays indexes and the JPM or JP Morgan indexes. Those are bond indexes. And you can see mid-single digit returns for most bond indexes. If you look at that Barclays Global Aggregate, that's a good global bond index, up 5% for the year. And over the last 3 years, up on average about 5.5% per year. So with sort of the rate increases that we saw at the end of 2021 and into 2022, and now we've had rates for the most part sort of stabilized. That's created a little bit more of a stable environment for us to generate some decent returns in fixed income and has returned bond exposure in portfolios to more of a participating asset class. And just quickly at the bottom right, you can see there the Treasury rates through September 2025, the 10-year Treasury, often referred to as the risk-free rate at 415 basis points, 4.15%. Again, those will fluctuate with interest rates moving up and down. We've had a couple of cuts, as I mentioned here earlier in 2025, and remains to be seen what the Fed will do in December, but pricing in an additional cut before we get to the end of the year. Let's switch gears and really look at U.S. markets as represented by the S&P 500. Again, we're going to be talking about some concentration in this index, but this chart goes all the way back to 1997. And really what we're looking at here is on the far right. If you focus on the far right of this chart, you've seen this enormous run from the lows in 2020 after the global pandemic really impacted the global economy and markets. You've seen this really significant run with the exception of 2022, which was about a 20% pullback in equities. And now you've seen since then a pretty sizable move up. Of particular note, we look at one of the metrics that we use to sort of evaluate the relative price of the S&P 500 and other indexes is this forward price to earnings ratio. It gives us a good indication of the relative attractiveness of the valuation of these stocks. And you can see there that as of 9/30/2025, the S&P 500 had a forward PE of about 23 times earnings, which is higher, certainly higher than the average, and means that stocks are particularly here in the US, are pretty expensive at the moment. And so that is one of the factors, not the only one, but one of the factors that we look at as we determine asset allocation mixes in our balanced funds and how we position portfolios moving forward. I would also note that we get a question quite often in our portfolio reviews about, with new money coming into the market, if your church or organization received a recent bequest or sold a property, what's the best way to go about putting that money to work? Is now the time to do it? Is it time to do that over a period of time, sort of a dollar cost averaging strategy? Should we put it in the mattress? Is a question we get a lot. And so we'll be talking about that as well over the next couple of slides. And with that, I'd like to bring in my colleague on the institutional relationships team, Stacy Pettis. Stacy is the primary point of contact and valued professional for our clients up and down the East Coast in the state of Pennsylvania. And Stacy, I welcome you to this call. I know that you're going to go through the next slide and introduce our investment team that's with us as well. So Stacy, great to see you tonight.
Thank you, Matt, and welcome again, everyone. Thank you for being here. I am going to be covering a couple of slides and bringing in some of our colleagues from our investments team as well. As we look at this chart here, I'm just going to kind of give some context. Since the market pullback in 2022, US markets have been on a consistent upward trend, leading to all-time highs in the S&P 500, which Matt just recently spoke about. Much of those gains that were experienced were driven by the Magnificent Seven companies, which we've talked about in previous town halls and also in client portfolio reviews that we've done with you offline. This slide takes a look at the top 10 stocks in the S&P, which equate to nearly 40% of the overall market weight of the index, which is significantly more concentration than we've seen in the past. My colleague Minothi Dhanaraj from our investments team, I have a question that I wanted to pose for you in terms of how does UCF use diversification to mitigate concentration risk? And if you would, help our clients understand the concept between market bubbles and or versus concentration.
Thank you, Stacy. That's a great question. So as you noted, the market is extremely concentrated right now at a historical high of 40%, as you can see on this chart. And, I wanted to note that market concentration is not synonymous with the market bubble. So when we say a market bubble, it generally refers to when asset prices rise above its intrinsic value, driven by a lot of speculation in the market, right? So if we think back to like the dot-com bubble, there were a lot of craze and movement into internet stocks, but many of these stocks were unprofitable. That is different right now. So if we look at the Magnificent Seven, they've been having strong earnings growth and are quite profitable. So in terms of the market concentration, we currently don't have a concern in terms of it being a bubble, but it could be growing into one. One aspect that I think that everyone should be aware of and that we are aware of is the recent debt issuance by the Magnificent Seven. So just in the month of September, it was double the amount that was in the entire previous year. So that's just something to keep an eye on. In terms of your first part of your question on UCF's diversification, this is the reason that we diversify across the portfolio in terms of geographies, asset classes, managers, market capitalizations, to make sure that we secure and make sure that we don't have to have the risk of the concentration that the market currently has.
Great, thank you, Minothi.
Sure.
I think as we flip over to the next slide, Matt, you have a question for our team as well.
Thank you, Stacy. Thank you, Minothi. Appreciate that. Yeah, the question we do get a question all the time in portfolio reviews, about our stocks are really expensive, and there's just a handful of them that are driving markets. Is that a bubble? So I want to thank you, Minothi, for taking the time to really kind of unpack that and the differences, the sort of the structural differences there. We have a slide in front of us that's talking about some of the GDP growth that we've seen going back to 2021, and I want to bring in my colleague, our chief investment strategist, Lon Kai. Lon, it's great to see you tonight. And as we look at this slide, we can see that we've had pretty significant GDP growth from Q1 to Q2 in 2025. And if you look even historically, as we've kind of come out of the COVID pandemic in 2021 and 2022 and into 2023, GDP and GDP growth has looked fairly solid, and that's sort of created a good foundation for the stock market and for investors to have some confidence in the market moving forward. However, as we go to the next slide, we can look at the labor markets and see that is one potential place. Adam, if you wouldn't mind just moving forward one slide, thank you. We can see that labor markets might be a place where the economy is maybe showing a little bit of a chink in the armor. When we look at this on the chart on the right, which is from the Bureau of Labor Statistics, unemployment in the U.S. was about 4.3% in August of 2025, slightly higher than in previous months, but holding fairly steady. What's been surprising is the significant downward revisions that we see in the chart on the right to the initial reports over the last couple of years in particular. Now, there have been downward revisions in the past, but you can see how significant those downward revisions were in 2024 and 2025. So these revisions, when we kind of go back in time and say, well, that report wasn't quite as good as we thought, that can create some market volatility and some uncertainty for investors about kind of where markets are headed from here. So, Lon, my question for you, when you're looking at all of the research and data that we have access to at United Church Funds, give me a take and give our clients a take on our sort of relative position on the overall health of the U.S. economy, and how is that working to shape our asset allocation strategies in our managed funds and particularly in our balanced funds?
Yeah, good to see you, Matt. And
Good
then
to see you.
nice to see everybody too. So very good question. The overall US health of economy is relatively in a good shape. As you noted that the first quarter GDP was negative. That's because a lot of front run in the import. So when you have a big net import number, it actually dragged the GDP down. And then for that same reason, after Liberation Day, there's a bit of pause on import. So it becomes a net exporter. And then that contributed 4.8% of the GDP. So with this tariff on and off, it creates a lot of volatility in the data. However, over the last 8 quarters, GDP's growth near 3%. So we are seeing pretty strong real GDP growth. That is primarily driven by two factors. One is resilience in the consumers. So the top 10% of the consumers now makes about close to 50% of the total consumption in the US. And you know that the consumption number in the overall economy is very big in the US. So that top 10%, given the wealth effect, has growing its consumption according to Bank of America's most recent estimates of 4.6% year over year. So that's very strong. And then the other driver is really AI-related capital spending, and that provided quite a bit of GDP growth as well. However, we're on this chart. We are seeing the non-farm payroll number in terms of monthly ads has been declining. Yesterday, finally, we ended the 43 days government shutdown, but we don't have non-farm payroll for 2 months in a row already. But we see some softness not only kind of in the labor market, and then yes, there are announcements of Amazon job cut, UPS job cuts. The bottom 50% of the consumer are seeing some challenges. The auto loan default rate is going up. The delinquencies in the students' loans is also going up, and then credit card charge rate is also going up. So there are start to have some weakness in the economy, and we're watching that very closely. Matter of fact, at the beginning of October, we took some profit from the strong rally in the equity market across all three balance funds at UCF. So UCF balance, BFF balance, and then also alternative balance. So right now we are close to the benchmark 60-40, and then we'll continue to monitor that closely for our investors.
Thank you, Lon. So just to thank you for that response, and certainly with the government shutdown, we might have a little bit of a lag with some actual numbers coming out of the government, right? So that impacts Fed decisions, that impacts obviously some of these reports, and maybe might be a reason for some future downward revisions. But I want to make sure that our clients heard you there, because we're taking a look at sort of where markets are valued, where the economy is positioned. We're kind of taking all of that into consideration. And early in October, we moved from a little bit of an overweight equity position in our balanced funds more to a neutral position, to that 60-40 in the balanced fund and in the traditional balanced fund and the Beyond Fossil Fuels balanced fund. So I want to make sure that our clients understand that we're sort of seeing what's happening in the market, seeing what's happening in the economy, and taking steps to sort of take some of those gains off the table, take maybe a little bit of equity risk away from the portfolios. If the equity markets continue to push forward, we're still going to participate in that with 60% of the assets. But we move to a little bit of a different footing just to be sure that we're protecting assets for the long term. So I just wanted to put a finer point on that. I want to thank you for that answer. I also want to bring Stacy back in, and Stacy's going to talk to us and ask a question about Fed rate cuts. Stacy?
Right, Lon, while we still have you, investors in the markets digested two quarter rate cuts in September and October and are pricing in another rate cut at the next Fed meeting in December. This dot plot shows rate projections by each member of the Federal Open Market Committee, with consensus that in 2026 as well as 2027, and most likely the longer term, being a rate environment that's lower than what we're experiencing today. So my question is, there's an old saying in Wall Street of "don't fight the Fed," right? If that's true, how does the projection for a lower rate environment impact our asset allocation strategies for equities and fixed income?
Yeah, thank you for that question, Stacy. And I totally agree that don't fight the tape and don't fight the Fed. So the Fed resumed its rate cut in September and in October. Right now, it stayed at 3.75% to 4%. And then if you look at the dot plot, it's projecting three more cuts until the kind of the longer term neutral rate they call it is about 3%. But who knows, when we have a new composition of the Fed, they may even lower the kind of the longer term neutral rate. But what is important for the last two cut is that the Fed is cut, they call it inflation cut, maybe in responding to some softness in the job market, labor market, but they have cut in the environment that we have strong GDP growth, and then we are almost in the full employment situation, and inflation is hovering at 3%. So when that three condition exists in the cut, it's called a bullish cut. So what it help is going to boost the financial asset price. And that is one of the reasons that we stay neutral, 60-40 for the balance funds. We're not going to cut all the way down to kind of underweight in the equity. Having said that, the rate cut would also have impact differently. So, for example, in the third quarter, we start to see the leadership broadening into small cap and emerging market. And that trend will persist because in the small cap, a lot of the company is financing through floating rate structure. So lower short-term rates will help them their financing and also would help their profit margin. And then therefore that the small cap may finally do well. And then on the other hand, when you have a rate cut, still in the face of some inflation, the currency might weaken. And this is also why we've seen that the international equity and the emerging market equity has been doing well. So it has implications towards financial asset classes across different regions and then in different segments.
Thank you. Thank you for that context. As we transition to the next slide, that looks at the 60-40 portfolio versus cash, we frequently receive questions from our clients about how to allocate assets, especially within short-term time horizon. Do we put it in cash? Do we stay invested? Is always the question. The chart that we're looking at suggests a diversified portfolio of 60% stocks, 40% bonds can return in excess of cash yields, even over shorter time periods. So right now, UCF's cash and equivalents fund is yielding about 4%, but that will most likely decrease as rates are lowered, which Lon was just speaking about. So in 2025, our UCF balance fund returned almost 13% net of all fees through the past 3 quarters, outperforming cash by about 10%. I want to bring back Manothi for this question. If you could, as we look at intermediate to long-term time horizons for clients, Is 60/40 still a reliable model for their intermediate and long-term investments?
Thank you, Stacy. So I think the key point of this slide is really stay invested in the market. As you noted, kind of looking at this chart from shorter time periods to longer time periods, the 60/40 portfolio outperformed just holding cash. And so this allocation really offers a consistent risk-adjusted return against market volatility over, the decades. So this goes back to 1995 in terms of this chart. And then even in a period such as 2022, where both stocks and bonds both went down in the same year, which is, typically not the case. If you see the years after that, those returns came back. So the key point is to stay invested in the market, and that it will beat cash over both shorter and longer time periods.
Great. Thank you so much for that. I know there's a lot of uncertainty right now, and so that's very affirming for our clients to hear about the portfolios and how staying invested really over the long term is more added value for them. I think we're going to transition now into some Q&A for our team. So Matt, I will hand it back over to you if we have some questions in the Q&A box.
Sure, Stacy, thanks. So we do have a couple of questions, and I would remind you that if you'd like to put a question in there in the Q&A box, we're happy to answer those. We've got about 5 or 7 minutes left in our call today, so we're going to take the time to get through some of these. So Carl Lehman has a question about the UCF Balance Fund, and his question is about what percent of the equity portfolio is invested in the Mag 7 tech stocks, and do we consider this to be satisfactory? Well, I'm not sure if we would consider it to be satisfactory or not, but let's remind everybody that the Balance Fund has a target allocation of 60% equity, 40% fixed income. As you heard us earlier, we are pretty close to that target of 60/40. And based on the 6/30/2025 fact sheet for the Balanced Fund, of the equity in that Balanced Fund, about 17% of that is allocated to the Magnificent Seven. And you'll find all of those, if you look at our fund fact sheets, you'll find all of those companies are included in the top 10 holdings of that equity portfolio. I should use this also as a plug to say that our 9/30/2025 fact sheets will be out soon in the next handful of days, probably early next week, and so we'll make sure to send those out to all of our clients who are subscribed to receive our updates. And I would encourage you, if you're not subscribed, to go to our website at ucfunds.org, click the subscribe button, and put your name and email address in there, and we'll send you a couple emails a month with really good and pertinent information from our organization on a variety of things, including when those fact sheets are available. Dave Harris has a question. How is UC Funds taking advantage of the comparative higher growth in Europe and developed international equities? Well, Dave, as you heard us say earlier, emerging market equities have done well. International equities have also done well in 2025, generating some pretty positive returns relative to other markets. I would say that we do not invest as heavily in emerging markets as maybe some other traditional funds, and that really has to do with some of our human rights screens and some of the countries that are included in emerging markets, places like China and others where we might run into some issues with their human rights practices, supply chain issues, how they use labor. And so while we don't have as much emerging market equity as maybe some of our peers, again, when we go back to the 9/30 numbers, the international equity component of our balanced funds, again, in the equity side, about 40% of the equity in those in the UCF Balanced Fund specifically was allocated to international equities. So we leaned in there a little bit. As I mentioned, that has probably come down a little bit from those levels because, again, we stepped back a little bit from a little bit of the overweight in equity that we had in the balanced funds. But to give you an idea, as of 9/30, about 39% of the equity was allocated to international markets. Tim Bertuccini, Tim, great to have you on the call. Thanks for joining us. He has a question: is 60/40 too conservative? Are we missing out on some of the tremendous rise? And he says, I am on the other side of the coin, so to speak. Well, I'm not sure what side of the coin you're on versus us, but I would tell you that we have a lot of clients, Tim, that where they've elected to allocate a portfolio closer to 70 to 75% equity, 25 to 30% in fixed income. We also have clients that are more allocated to equity even than that. And so it really comes down to the goals and objectives of each client, their sort of relative comfort with volatility, because we do know that while equity has has the potential historically to provide higher returns, it also might lead to a little bit more volatility. And it also has to do a little bit, frankly, with the draw rate as well. So, churches that aren't drawing as much, churches and organizations that aren't drawing as much from their long-term assets, and relying on that income, they can afford typically to be maybe a little bit more aggressive and allocated into equities because they can live with a little bit more of that volatility. So whether 60/40 is too conservative or not really depends on the client and their goals and objectives. Of course, our balanced funds have are the two balanced funds that are used by most of our clients, the UCF Balanced Fund and the UCF Beyond Fossil Fuels Balanced Fund, are 60/40. We have the ability, and I'll remind you, we have the ability at UCF to go up to 70/30 based on market conditions and sort of based on what the market is giving us. So we have some nimbleness and some flexibility, and our investment team does a terrific job. Our performance bears that out historically about navigating those markets and being able to pull those levers, allocating and then underweighting or overweighting to equities versus fixed income. Dave Harris with one last question. Can you interpret that the international component consists mainly of developed international? Yeah, that would be accurate. And you can a good resource for you there for all of the folks listening to that might have a question would be to go to our fund fact sheets and to look at the International Equity Fund. And that fund fact sheet will give you a really good idea of what our international component looks like within the balanced funds. That fund is a managed fund. It is one of the building blocks of the UCF Balanced Fund. And that's a good place to sort of dig a little deeper on the various countries and different allocations that we have there. So thank you for all of those questions. So with that, I am going to take this opportunity to thank my colleagues on the call, Lon and Minothi from our investment team. I'd like to thank Stacy and Kelsey from our institutional relationships team, Matthew, of course, Charles, and Debbie and Adam behind the scenes. I'd like to also take a moment to thank all of our staff members at United Church Funds. We have a terrific team. We have some new faces on our team. For those of you that deal with our client services team, you might see some new names sending you emails back. Please take an opportunity to welcome them to the UCF family. They are doing a terrific job on behalf of all of our clients and on behalf of our team in support of your missions. And lastly, I want to thank all of the folks that took the opportunity to listen to this webinar. Whether you're with us live or listening to the recording, we're really grateful that you took the opportunity. We hope you found the material that we shared with you useful and informative. And we hope that you take it back to your local church or your organization and share the message of responsible investing and generating competitive returns over these longer periods of time to be in support of your missions and ministries. So once again, I want to say thank you so much. I really appreciate everyone's time tonight, and have a great Thanksgiving holiday.